Welcome to this video. We're going to develop now chapter 33, Aggregate Demand and Aggregate Supply. This is the phase for video. This is the new format that we are developing. Let's hope it's better with a face in the video. So let's start. So basically what we have before is like we understood that economics growth is basically based on the labor force, increasing capital stock, or even advances in technological knowledge. So under these situations, we can understand that the economy produces more over time. And basic with this higher GDP or higher real GDP, we are providing higher standard of living. Actually, in the past half century, real GDP has grown 3% on average in United States. But actually this is not normal that all the time the economy is growing. Let's have a look what's happening here in 2020. So sometimes the economy does not grow. Actually it contracts. So under this situation, when the economy is in contraction, the workers are laid off. So when the workers are laid off, so basically we are experiencing more unemployment. So under this situation, we have the real GDP declines and is what we called a recession. And what we called a depression is even worse. So naturally now with the COVID-19, we are experiencing a depression time. We have the normal example before the pandemic. We have downturn USA in 2008 and in 2009. Actually, the US economy fell 4.2%. We have talked previously in the previous chapters regarding the long run. And we have talked about the situation in the long run, and we have talked about more real variables. Now we're going to verify right now what is going to happen with the nominal variables. And this chapter is going to be about the aggregate supply and aggregate demand. So the first thing is like the three facts about economic fluctuation. So the fact one is that economic fluctuations are irregular and unpredictable. So for this reason we have refer about this situation as the business cycle. So it's not regular and it's not easy to predict. So if someone says to you that this is the time to invest, this is the time of disinvest, well, maybe you can predict kind of a behavior, but 100% is impossible. Otherwise everybody will get rich, right? So then, this is the situation or the graph for the real GDP for the United States from 1970 to 1915. As you can see here, the trend is like upward. It's like upward slope for the real GDP. However, it's not all the time the same. Let's have a look to the bars in red. So these bars in red reflect that during these periods maybe the real GDP was even declining. So here we have the 1975. So we have here 1980s two times, we have 1990s, and here 2000, and here 2008-9, like the most important decline during these 45 years, right? We can imagine now about this COVID-19 definitely should be even worse to this graph, and this is not going to be just 2020, but even we can start thinking about difficult situation in even 2021. So here other variables, other macroeconomic variables that we can understand and associate with decline of the real GDP. We have here the investment in spending. So as you can see here, the decline is even like sharper than before during this period of time. So definitely these two variables is what we call they are in some way correlated. And what about the unemployment rate? Well, it has exactly the same situation. When there is a depression or there is the recession in the economy, the unemployment rises. So then here we have exactly the same bars that we have analyzed before, and we have here a little bit above 10%. You can see that maybe this is important, but if we can think about COVID-19, even the line will be out of this graph, will be close to 20% in the United States. Okay, so then fact 2, most macroeconomic quantities fluctuate together. So real GDP naturally is the most seen variable, is the more like kind of comprehensive, but well, we can see that for a recession the GDP decreases, but also personal income, corporate profits, consumer spending, investment spending, industrial production, retail sales, home sales, etc. So then these other facts is what we are unfortunately experiencing today. 3. As output falls, unemployment rises. So we already saw in the third graph the behavior of the unemployment. So when firms produce less, they lay off workers because they don't need the same quantity of production factors to produce. And one part of that should be naturally the labor, which means the workers. So actually, even in period of economic expansion, unemployment is not zero. This is what we call like a natural rate of unemployment. This is basically because sometimes when it fluctuates the time, maybe you are laid off from one work or you quit one job and you start looking for another. So this is like some normal period of time that you're still looking for a job. So then is what we call the natural rate of unemployment. So it's never zero. So actually, we're going to talk now about the short-run economic fluctuations, so the assumptions of classical economics. So to set up this and to maybe stay better in the situation that we are explaining now, chapter 25 talks about the level and growth of productivity and real GDP. The chapter 25 and chapter 27 how the financial system works and how real interest adjusts to balance saving and investment. The chapter 28, why always unemployment in the economy? And then 29 and 30, the monetary system, changes in monetary supply and how they affect the level of prices. And we have discussed about the classical dichotomy and monetary neutrality. What does it mean? Basically is that we separate variables in real and in nominals. So what we discussed before, we have talked about real variables. It's what we said quantities and relative quantities. And the nominal variables is when you have involved the a situation of prices. So actually the classical dichotomy set. Okay, if the quantity of money is the double, so naturally everything would cost the double. We're going to receive the double in our salaries, and naturally everything will be exactly the same. But actually, in some way, what classical dichotomy says, like money is available. But basically the situation here, like in the short run, maybe it doesn't work the same situation, because the prices double, everything cannot adjust immediately to this situation. So actually we're going to have a look of the reality of the short run fluctuations. So in the chapter, basically here we have like most economists believe the classical dichotomy describes more economy in the long run than in the short run, when actually the variables they are affected by prices. But in the short run, real and nominal variables are intertwined. So then, the changes in money supply can push real GDP away from its long-run trend. Basically, what is happening now? We know that the situation of the contraction is evident. However, the economies, they are making some fluctuation with the money supply to like keep the economy like the less worse possible, to try to keep at least a level to avoid this recession or this depression so high. But anyway, it's so hard to keep the economy well when you're not producing exactly the same. So we're talking now of a new model when the real and nominal variables interact. So the model of aggregate demand and aggregate supply is going to provide an idea how the economy adjusts in the short run. So we have here two variables. So we have from one side the real GDP, which is going to be in the x-axis. We have the average level of prices, which is the deflator, or the CPI, which is the Consumer Prices Index. So just a measure of the prices. And the output is real variable. And the level of prices is nominal variable. So we have here two variables, but one of these is nominal, which is the prices, and the other one is real, which is the output. So basically the aggregate demand curve shows quantity of goods and services that the households, firms, the government, and customers abroad want to buy at each price level. From the other side, we have the aggregate supply, which is a curve that shows the quantity of goods and services that firms produce at each level. So here we have the normal graph that we're going to face every time that we want to analyze the aggregate demand and aggregate supply. We have the normal curves as a normal market with this weekend standard slope. We have the AS, it stands for aggregate supply, and AD, aggregate demand. We have the level of prices, which is the equilibrium price level, and the equilibrium output, the quantity that is produced in this economy. Well, this is kind of difficult because you can think, okay, but this is exactly the same as we saw in chapter 4 when we discussed about ice cream market. But actually, what we saw is like when you are in the ice cream market and maybe the price is so high, you can move to another market to demand another good. You can go for another dessert, a tiramisu, for example. But in this situation, it's not the same because we're talking about all the economy. There is no substitution here. It's not possible. So in this case, for example, what we are talking about, like higher price in the market raises the quantity supply. So more workers are required due to the increase in the prices. What we saw, what I said before, the macroeconomic substitution is impossible in world market. Let's talk about now the aggregate demand curve. Naturally, there is a negative relationship between prices and quantity demanded. How we can infer that? Basically, this is the main situation that we need to keep in our mind. So we have the GDP is consolidated by the consumption plus investment plus government spending plus net exports. We keep here the government spending fixed by policy, you know, like it's going to be fixed, it's going to be provided, given by this model. So we're going just to move the other part. So we have here the price level and consumption, which is the wealth effect. So it means like the nominal value is fixed, so $1 is exactly always a dollar. But when the price change, it decreases your dollar and is more valuable when the prices decrease. So then, in the other situation, when it increases the prices, the dollar is less valuable. So this is one main explanation why the slope of the aggregate demand is downward. What about the price level and investment? What we call the interest effect or the interest rate effect. So the price level is the determinant of quantity of money required. When the price is lower, people actually don't need too much money to buy goods and services. Imagine that the Big Mac now it costs just 10 cents, so you don't need more the $3 that you paid before. So then you have more money available. You are like wealthier in some way. So when you have more money, what you can do? Actually, you can go to the market, so to the investment, so you can make an investment. So then when there are more investment, more money available for banks, so then it's going to be a reduction for the interest rates. Could be the situation. With lower interest rates, make borrowing naturally is less expensive, so firms borrow more, invest with new plans and equipment, basically because of the incentives. Taking out the situation of maybe you don't have like trust for the economy, like how it's happening now, that even the interest rates, they are low, people don't want to take money for investment at this time. So then definitely this is another history. Now we are keeping the other things exactly the same. So for this situation, then the firms borrow more, invest in new plants and equipment due to the decrease of the interest rate. Households actually are tempted to borrow for new houses, and with lower interest rate, it stimulate consumer spending. So for example, cars. When you buy a car, sometimes or most of the times you don't have all money in cash. So maybe you have one part, another part you take on credit. So then for this situation you are more tempted because of the lower interest rate. When we have lower prices, there is a reduction in the interest rate. It provides greater spending and then increasing quantity of goods and services demand. When we have higher price level, so this is going to be the opposite, raises interest rate. We have here lower spending, decrease in quantity of goods and services demanded. Now, let's talk about the price level and net exports, the exchange rate effect. So when we have lower prices in the United States, we know that we have lower as the US interest rate. So then some investors will find higher interest rates abroad. So they prefer to invest abroad instead of investing in the United States. So imagine then that they will find German assets because the yield is higher over there. So then it should be a higher supply of US dollars because they need euros to make those investments. So when we have more supply of this good, naturally it's going to be a depreciation of the price is lower, so dollar depreciate relative to euro. So each dollar buys fewer units of foreign currency because between quotation marks population is like poorer. So then the foreign goods become more expensive to domestic goods. Then we have here that basically the foreign goods are now more expensive, so Americans buy less from other countries, so United States imports tend to decrease. But the US goods are now cheaper, so then foreigners buy more from the United States. So then the US exports increase. So then, as you remember, the net export are provided by export minus import. So from one side we have a decrease in the import and increase in export. So then as a consequence we're going to face an increase in net export. So lower prices make an increase in aggregate demand. This is another explanation why the aggregate demand curve is downward slope. The third reason is there are three reasons of fall in price level. So first, the consumers are wealthier, then stimulates the demand for consumption goods. The interest rates fall stimulates the demand for investment goods. And third, the currency depreciates, which stimulates the demand for net exports. So then the same three effects work in reverse. So then there is a relationship, a negative relationship between prices and between the quantity. So then all this is keeping the money supply constant. We are not moving in at all this other variable. So now, why the aggregate demand curve might shift? Well, the shifts in arising from changes in consumptions. So first, all the things that are not explained but changes specifically in prices, so are things that they're external, is what we call exogenous situations. So then people are more concerned about by saving, reduce current consumption. So then this is an external situation, so at the same price level people consume less. So then the aggregate demand shift to the left. Other situations, stock market boom. People make people more wealthier, less care of saving, so then start to consume more, so the aggregate demand shifts to the right. At the end of the day, any situation that make a change in people to want to consume, it makes a shift into the aggregate demand curve. For example, changes in fiscal policy. So it provides incentives to consume more AD to the right. Cut in taxes, so you have more money available, so you spend more. Or it makes a shift, all those, for example, this makes shift to the AD. Okay, so what about shifts arising from changes in investment? So any event that changes how much firms want to invest at a given price level also shift the AD. What is happening right now with the coronavirus? Definitely, because all firms, they don't want to invest. It's like a period that the uncertainty, total uncertainty, so then the AD should definitely go to the left. So in this situation, well, we have, for example, when firms pessimistic about future conditions, what is happening right now, investment decrease at the same level of prices. We have the other situation, the tax policy charging up, subsidizing investment, affect AD through investment. So if it's good for investment, it shifts to the right. If it's wrong, it's like worse for investment, it shifts to the left. So then it stimulates investment spending. So AD shifts to the right. Okay, so then what about shifts arising from changes in government purchases? So it directly increases the AD to the right. So government increase of purchasing, what is happening now is trying to like push this demand to the original position, is what the government is doing right now. So for example, government start to build more highways, so AD shifts to the right. Or shifts arising from changes in net exports. So Europe, imagine that experiences recession, so they demand less from the US. It's what's happening now. All countries are demanding less from all countries. So Europe is in expansion, so they demand more from US. So speculators lose confidence in foreign economies, so want to move some wealth into US economy, so then more demand for dollars, so then there is an appreciation of the currency, so then it depresses net exports, okay, because now all the goods are more expensive in the foreign market. So then why the supply curve is vertical in the long run? So then we have like total quantity that firms produce at the determined level. In the long run, the aggregate supply is vertical. So production of goods and services are real GDP. So it depends on supplies of labor, capital, natural resources. So we didn't make any reference on overall level of prices. So for this reason, prices don't not affect output production in the long run. So long run is a representation of the classical dichotomy and money neutrality. So it means that there are no effects from nominal variables into real ones. So what we call is like the long run is called sometimes the potential output or full employment output. Is what we said, or we refer to the natural level of output. So when the unemployment is under natural levels, so we can say like around a little bit lower from 5%. So any change that alters natural level of output shifts the long run aggregate supply curve. So what are the changes that shift this long run curve to the right or to the left? The first situation could be related with the changes in labor. So imagine the situation of an increase in immigration. What is happening now in Europe, for example? So the quantity of goods and services supplied would increase if this, in some way, Europe can aggregate these people to the labor work and can provide naturally human capital. Then in terms of productivity, they can reach better standard of living and could be more productive for the economy. So if workers go abroad to work, as is happening, for example, in Mexico, in my country, Colombia, so then the aggregate supply will contract. It is related with unemployment in a natural rate. So for example, Congress raised minimum wage, so it increased of unemployment. So the aggregate supply shift to the left. Other situation that make this supply curve in the long run shift is about the changes in capital. So then, remember the capital, we are talking about machines, we're going to be talking about plants, even human capital, the education. So increasing the economy's capital stock increases productivity. Then the output of quantity of goods and services supplied, it shifts to the right. So then shifts arising from natural resources. So maybe a country discover a mine, discover more oil. Hopefully not. I don't like more oil in our country, in our world. But anyway, these changes like land, mineral, weather, then shift to the right. When there is a change in weather patterns that difficult forming, AS shifts to the left. So this is something that it could be an issue with the situation of the environment. This should be a situation that at the end of the day, now we're experiencing like higher production, but maybe in the long run we're going to experience like contraction of the aggregate supply for the lack of natural resources. Other situation that can move the aggregate supply could be the technological knowledge. So then one of the explanation why we produce more today than before, the invention of computer, the shift AS to the right, regulation to prevent environmental issues. So AS shift to the actually to the left, right? Because there are restrictions, so maybe it could be an issue, but at the end of the day, it could be better if we want to keep living in this planet. So then, we're going to try to use aggregate demand and aggregate supply to depict the long-run growth and inflation. So we know the situation here that you have to keep in mind that the most changes for technology and monetary are monetary policy. So all situation about money supply is what makes this situation. So these are both moved by two situations. So technology is more about related about supply, and monetary policy is more related about consumption, about demand. So in the short run fluctuation in output, it can be seen as a deviations from the long run trends of output growth and inflation. So here we have exactly the same situation. Let's graph here the situation in 1990. So we have here a level. This LARS stands for long aggregate. Long aggregate. Long aggregate short run. Okay, so here I guess that this SR, long aggregate short supply. Okay, so here we have, I guess that I said wrong, should be like supply for the long run, something like that. It's the aggregate supply for long run. Okay, this is the 90s, and here we have the aggregate demand in the 90s. So here we have this level of prices in the 90s. If we want to believe of changes in the monetary policy, we have here an increase of all the variables of the GDP. So we have higher investment, higher consumption, higher net exports. So here we have the situation of the aggregate demand in 2000. But then, because of technological changes, there is a change in the long in the long aggregate supply, long run aggregate supply. So hard to say this abbreviation. Okay, so then here we have the price for 2000, so then we have a little bit higher, and then this situation for 2000. So we have here higher quantity of output and higher quantity of prices. So then this is how the situation of the economy in general terms has changed. So then in the short run, the price level affects the economy's output. So a market imperfection causes supply behaves different in short and in long run. So the quantity of output deviates when the actual price in the economy deviates from price level that people expect to prevail. So then, for example, if the price level rises above the level that people expected, so output rises above its natural level. So why we say that the level prices make changes in real variables in the short run? So the first theory that explains that situation is the sticky wage theory. It says that the nominal wages are slow to adjust to changing economic conditions. So there are long-term contracts between workers and firms. So sometimes even for 3 years or indeterminate. So for example, if the firm believes that the price level should be 100 and they pay or they fix at $20 per hour, now imagine that that's not the real truth. So the situation is like now the price level is 95. So the prices have fallen under expectations. So then for the firms is really nice because they're getting 5% less for each unit of its product that is sold. It's not really nice. I'm totally wrong. It's complete bad for the company because naturally they're going to sell to lower price. Sorry, I misunderstood. So then the production is less profitable. So then it hires less workers and output supply. Then the nominal wages are slow to adjust to changing economic conditions because there are long-term contracts between workers and firms. Sometimes even 3 years. Well, this is exactly the same as before. So then this is the first situation, the sticky wage theory. The second one is the sticky price theory. So prices of some goods and services adjust sluggishly in response to changing economic conditions. So what we said in economy about the cost of adjusting prices all the time, day by day, is what we say menu cost. So imagine that you have a restaurant and from one day to another day you need to change all your menu and change prices. And what are going to say your customers that they every single day they go to eat, they face different prices. This is bad. At least the prices are falling. Otherwise, people get mad. So then the print and distribute new prices is a cost. So then imagine that economic condition make to fix prices lower. So then this is a situation that firm does not fix and the sales decline. So then when there is this issue, what is the situation? The firms reduce produce quantity because they couldn't handle the movement of the prices, so they couldn't find or they couldn't change the level of price. So then the quantity of output supply is exactly equal to the natural level of output plus a variation. This variation is a gap between the actual price level and the expected price level, and this is multiplied by an A. This A is how much output responds to unexpected changes. If this A is higher, the variation from the quantity of output supply, the long run situation should be definitely different. So then this should be an issue. And the last one I just skipped is the misperception theory. So changes in overall price level, so then people start to produce more. So for example, wheat farmers, when price fall, if they think that just wheat has fallen, they reduce their production. So this is what we call the misperceptions theory. So all these theories are based on rigid prices, wages and perceptions. So they adjust just in the long run. So then, When we consider all those variables that shift the long run aggregate supply curve, so then we're going to have a look about the change in the aggregate supply. So additional variable should be the expected price level. So changes in labor, capital, natural resources, or new technological knowledge. So when we have here an increase in capital stock, there is an increase in the short and long run. When workers and firms expect the price level to be high, so likely workers will reach higher nominal wages. And these and higher costs reduce the quantity of goods and service supply, so AS shift to the left. So it depends. If it's good for the supply, it shift to the right. If it's bad, it shift to the left. So two causes of economic fluctuations. So we are going to have a look here shifts in aggregate demand and aggregate supply. So the situation is basically about the expected prices are equal to actual prices. This is the basic situation. So we have here the long run equilibrium when the expected prices are exactly equal to these actual prices, because even this A, which multiplies this gap, is higher, it multiplies by 0, so it's exactly the same. So then the effects of a shift in aggregate demand. So pessimism overtakes economy, crashing the stock market, the COVID, households cut back on their spending, firms put off buying new equipment, it means like less investment, decrease of prices in short run. So in that, under this situation, expect prices is lower, so then they have like more workers, and then the long run aggregate demand shifts is a nominal change. So let's have a look here to the situation. So here we have the demand curve and the supply curve, the aggregate. So when there is a contraction of the demand, we have here this situation. So the first move, we have here a decrease in the prices and decrease in the quantity, so from A to B. But then, due to the decrease of prices in short run, so the expected price is lower, so you contract like more workers, okay, definitely. So then situation, you can move this the AS. So for this situation, the AD, the aggregate demand shift, is a nominal change because the quantity exactly remain the same, but just we face a decrease in the prices in point C. Then the previous situations, we saw that the policymakers, they do not make anything. As soon as possible, they see contraction. Maybe they can incentive AD throughout fiscal policy, throughout monetary policy. So for example, this one we have this situation. So then they can avoid this painful period of depressed output and higher unemployment, because they can reduce that in length and severity. What is governments they are doing right now? They are trying to make a lot of fiscal policy, a lot of monetary policy to avoid this period length. But anyway, this is impossible. We are already facing the worst. So in the short run, shifts in aggregate demand causes fluctuations in the economy output and of goods and services. Then we have here in the long run shift, the AD affect the overall price but not the output, because the aggregate supply shift to the right. So then the conclusion is that the policymakers then can mitigate the severity of economic fluctuations. So here we have, for example, situation of the US real GDP growth in 1900. So we have here the Great Depression could be due to monetary to money supply contractions. Actually, people say as well the collapse of stock market and reduction of consumption. So then as well as some restrictions to firms for investment. So here we have the decrease. But anyway, here we have the other compared, but with the COVID should be even worse or close to this one, what is going to happen. So then let's talk about the Great Recession of 2008 and 2009. Well, basically the situation was like there was a substantial boom in housing market. So more people buying housing market, housing properties. Basically, they were incentivized because of the low interest rates. So when you have a lower interest rate, less expensive to get a mortgage. So it contributed to an increase in housing prices because more people demand these goods. So we have here a more subprime borrowers. So then people that they started to invest in those mortgages or in assets that they were attached or associated with this mortgage. So basically it was like maybe underestimate the higher or the risk or the possibility of default for these people that they were buying these houses. And then actually it was a creation, well, this is the mortgage-backed securities that I said. So then from 2006 to 2009, the prices started to go down after this boom. And it should not be a major problem because actually it's part of the economic adjustment. But actually it started a substantial rise in these mortgage defaults. So then though a lot of firms that they bought a lot of these assets, they have major losses. So with this decrease of prices, actually banks, they start to get these houses, but the houses actually cost less than the real credit that they provided before. So then actually it was attached with a construction collapse as well. So then the owners of mortgage, naturally they have major loss. So for this reason we have a GDP decline by 4.2%. We have an increase of unemployment for 4.4% to 10%. And then there were actions from the government to return this aggregate demand to original place. Basically three policies: reduction of Federal Reserve interest rate, so then incentives to people consume more at the end, equity injections to the banks to recover these losses for the mortgage that they invested, and stimulus for government spending to recover this AD to the original situations. What about the effects of a shift in aggregate supply? So then imagine situation of the some bad weather. So we have here the long run aggregate supply, so it can also change. So we will keep this fixed for in terms for this explanation. And we have here that the higher level of prices and there is a full output is what we call a stagflation. So let's have a look here. We have the original situation. We have here a shift to the left because of maybe some bad weather, or maybe even if we can just analyze aggregate supply for a situation that we are experiencing right now. We have here an increase in prices and a decrease in the output is what we call stagflation. So then the situation here is like there is a higher expectation of prices. So then the workers they can negotiate a higher wages. So even can move more to the left is what we call the wage price spiral. So the situation here is like the unemployment is high with the time. So then there is a less bargaining power from the associations, right? So then for these reasons, maybe the policymakers can intervene, avoiding the natural adjustment of the market because it will take time. It will be even lower. So for this situation, can move the AD, the aggregate demand, to the right, and at the end of the day, a change in the aggregate supply in the long run with the adjustment should cause just an increase in the prices. So then the conclusions. So we have discussed about important fact about short run. So the prices they affect. So why? Because for example, right now policies is being made from the governments to keep the aggregate demand to the regional side, to keep the aggregate supply to the regional side. They are making a lot of efforts, but we need to take into account that data has a cost. We cannot just create economy for creating. We need to produce something. So then at the end of the day, this is unsustainable. So that's the key part of this situation. So we have a look for explanations of the fluctuation of the aggregate demand, aggregate supply, and the next chapter we're going to understand more about these fluctuations and actions from the policymakers. Okay, if you have arrived here, thank you so much for watching these videos. I really like that someone is taking advantage of these videos. I really like that we have impacted more than 1 million of people or 1 million of views. That's amazing. Even with my particular lessons, it has been impossible. So subscribe if you like it, or share this content with someone that should be interested, and we'll be more than happy that it has been useful for you. Take care and see you next video. Bye bye.